Hello and welcome back to our channel, The Running Bulls. I'm your friend and host, Dev Shakti. So let's continue with the part 2, Candlestick. So today we're going to talk about chart patterns. Chart patterns, in this we will focus on trend reversal chart patterns. So first of all, there is two types, bullish to bearish and bearish to bullish. Bearish, in bullish we have bearish triple top, bearish double top, bearish rising wedge, bearish head and shoulders. In bullish, bearish to bullish, bullish double top, bullish inverted head and shoulders, bullish falling wedge pattern, bullish triple bottom. Let's see one by one what are these chart patterns are and what we can learn from them and how to trade. So triple top. Triple top, as the name suggests, we have a three tops, uh, each showing the price reception from the top, and there is a neckline at the bottom, as you can see the dotted one. This we call a neckline because once it breaks, the price starts falling down. So let's see about in details. So triple top pattern entails two high points within a market, which signifies an impending bearish reversal signal. A measured decline in price will occur between three high points, showing some resistance at the high price. After retracing a portion of the first peak, as you can see, after retracing a portion of the first peak, the market rallies backwards towards the high of the first peak. However, the strength in the market is waning and is unable to sustain and break above the second peak. So in this, the first peak, it rallies back to the first peak and then again to the second peak, make a third high, and then the price starts falling. So let's see in how this pattern looks in the trading terminals. So this pattern looks like this. We have a triple top pattern. So first top, as you can see, then second top, then third top, and then a smart pullback. Smart pullback is to remove the weak traders. So and after that it starts coming down. So in this, the SL will be the stop loss will be the second top, and your target will be the difference between the top and the neckline will be your target. So let's move on to the next chart pattern. Next chart pattern, double top. As the name suggests, again it's similar to the triple top. Triple top was very rare, but double top is quite frequent and frequently visible. So again we have a price rejection, first price rejection, second price rejection, then making a neckline, and once the neckline is broken, the difference between the top and the neckline will be your target. So let's see, the double top pattern entails two high points again within the market, which signifies implementing bearish reversal. Again, it's showing a bearish reversal. A measured decline price in occurs between the second high, showing a resistance at the price high. After retracing a portion of the first peak, the market rallies back to the high of the first peak. However, the strength in the market was waning and unable to sustain. A break above second peak would take in a stop loss. Let's see how it looks like in a trading terminal. So double top looks like this. We have a first peak, second peak, then we have a neckline as we have seen in triple top. Once this neckline is broken, the difference between the first peak to the neckline will be your target, and your stop loss will be the second peak. Stop. Remember, guys, always trade with a stop loss. Next is the bearish rising wedge pattern. Now, bearish rising wedge pattern, it's a we have to connect trend lines. So all the dots when you connect, like lower end, you have connected. We are showing with a line at the lower part. So you have to connect all the dots at the lower end and also at the top end. So once again, when the neckline is broken, breakdown is given, then you can take a trade and bearish rise wedging pattern will be executed. Stop loss will be the high of the last green candle. So in this case, the high will be your this top. Let's take a detailed view. So it established uptrend, rising wedge consolidation formation. linking higher highs and lower lows using a trend line that we always already have seen that assembling towards a narrowing point. So it will get narrowed. A firm divergence between price volume and volume function. We'll also see in upcoming videos what are the how to use it with price volume and MACD. Overbought signal can be confirmed other tools like oscillators. Look for breakout support for a short entry. So if you see at the lower end there is a support. Once the breakout is given, we can take a entry. The entry point is labeled occurred when the trend line is broken. Obviously, we have seen a trend line has been broken. Wait for the candle to cross. So you have to wait for a candle to cross this lower end. So let's see in the trading terminal how does it looks like. See, it will look like this. There is a narrowing of the pattern. It starts with a broader view. It's going upward with an angle of more than 45 degree. So when the angle is more than 45 degree and going upwards in a channel connecting all the trend lines, and once the trend line is broken, you can take a trade. And trade, you can put a stop loss at the high of the previous candle, and you can short the stock index or anything what you are trading with. Next is head and shoulder. Head and shoulder is my one of the favorite one. So here we have a one shoulder, one head, and another shoulder. Once both the neckline is broken, again there is the importance of the neckline. Once the neckline is broken, you can take a trade. Let's take it in a detailed view. So head and shoulders chart pattern is a price reversal pattern. Helps trader identify when a reversal may be underway after a trend has exhausted itself. The reversal signal the end of an uptrend. The head and shoulder pattern has a distinctive appearance resembling its namesake, which includes distinct left shoulder, head, right shoulder, and neckline formation. Let's see how it look like in trading terminal. So this is a example. There's one left shoulder, one right shoulder, and a head, and there is a neckline. Once the neckline is broken, we can take a trade. There is a breakdown, and you can execute your short position. The stop loss will be the you can take a stop loss at shoulder of the right side or head also, but you can take it as a risk. You have to take you have to define your risk, then only take a trade. So in coming videos, I'll also put about the price, these about the indicators and the how to manage your risk. Next is the double bottom. Double bottom is similar to the double top or double top, but it's a trend reversal from bearish to bullish. So double bottom pattern entails two lows point near a similar horizontal price level signifies a potential bullish reversal. A measured strengthening in the price will occur between the two low points, showing support at the price lows. The double bottom chart pattern is found at the end of the downtrend and resembles a W shape. So if you can observe here, it's a type of W shape when it breaks out. So always you can trade on this one. It has a higher probability of success. So price falls new low and then rallies slightly higher before returning to the new low, unable to push lower lows. This bullish confirmation is signified by a break in key price level situation at the higher point between the bottom resistance and the neckline. Let's see on the trading terminal how it does it looks like. It will look like this: first bottom, second bottom, and there is a neckline. Once the neckline is broken, you can take a trade. The difference between the neckline and the second bottom will be your target. Always remember the second bottom will be your stop loss, and you can execute the trade. So in this case, there is a high chance, high probability of getting success. Also, this double bottom resembles somewhat like W pattern. Next, inverted head and shoulder. Inverted head and shoulder is similar to the head and shoulder that we have seen, but in this case, it is bearish to bullish. So the trend is reversing from bearish to bullish. So as the name already I have seen, let's talk about in details. So inverted head and shoulder typically in long position. It is for the long position when the price rises above the resistance of the neckline. The first and third are considered as shoulder. Second is considered peak. Second peak is considered as the head. A move above the resistance also known as the neckline, as we have already discussed in the head and shoulders. So it is inverted. Inverted means upside is downside. So you just have to don't have to be you don't have to be confused in anything. Just remember that inverted head and shoulder is trend reversal pattern in which bearish trend is changing to bullish trend. So let's see how it will looks like in the chart. So the chart, it will look like left shoulder, right shoulder, and a neckline. We have already discussed the difference between the neckline and the head to the head will be your target. So you can take a trade accordingly, and stop loss you can take as take a stop loss above the head. Falling wedge patterns. So falling wedge patterns is again similar to the that bullish one. So in this case it is the falling one. It is again changing the trend from bearish to bullish one. Let's see how we can talk about in details. The falling wedge pattern is interpreted as bullish continuation and bullish reversal pattern. Falling wedge is a continuation pattern if it appears in uptrend, and is a reversal pattern when it appears in a downtrend. So it is both kind of continuation and reversal. Continuation will study will I'll I'll show you in part 3. So key points: identify uptrend or downtrend, link lower lows, lower highs, lower lows, and using a trend line. Two trend lines will slope downwards and converge. So as we can see, two trend lines are converging downwards, and it's showing the uh, divergence also. So let's see in trading view, trading terminal, how it will look like. So this will be your entry once it crosses the trend line, and your stop loss will be the last low, and your target will be the difference of the backside. So this will be your target. Let's see next, triple bottom. Triple bottom is similar to the triple top. Let's straight away see in details. As the name suggests, triple bottom consists of the three consecutive lower lows printed at the same or near same level. For this chart pattern to occur to and be effective, price action has to trade in a clear downtrend. The seller has to push the lower to test the horizontal support for the first time. However, they meet strong resistance from the side of the buyers, and the price action rebounds as the sellers take a breath before the second attempts and going. Hence, the three main mandatory features of the triple bottom chart: downtrend security price must be trade lower, horizontal support should be there, a neckline should be there, and it has to be broken before taking a trade. Triple bottom chart pattern is rare but extremely effective reversal pattern. So how does it look like in the trading view? See, it is a downtrend coming two times the bottom and three times the bottom has been tested. The upper support neckline has been broken, and once it is broken, you can take a trade. So that's all for the today's. I'll upload the third part also. If you like my videos, don't forget to comment and like and share it. Thank you and have a nice